Good afternoon, ladies and gentlemen. A very warm welcome to you on Business Today Television. We are at a flat market on Tuesday. Absolutely nothing happening in terms of volume as well as price action on the Nifty, which is trading flat, 25,473 as far as the quote on the Nifty is concerned. And if you look at the intraday move within the Nifty, it is limited to 70 points. A low of 424 on the index and a high of 495. So it's a sideways trade not only for today but over the last 5 sessions. The Nifty, after hitting a 9-month high, is trading flat for two reasons. One, regulatory, and the other, of course, on the quarterly results. We are ahead of first quarter earnings, and before that the market has hit a 9-month high after rallying continuously for the last 4 months in a row, in which is added about 3,800 points or about 17%. Now the market is top heavy, and at this point of time what has actually happened is that there is a regulatory order that has come on one very large participant in the option space, which is Jane Street, and Sebi has debarred the company from the option space and has also imposed a fine of more than 4,500 crore rupees in its interim order based on how Jane Street allegedly manipulated options prices and the underlying securities to earn this huge amount of money, which tops about 40,000 crore rupees. To discuss this and much more, we have with us Mr. Arun Kejriwal, who's a market participant and a very fine observer of trends on Dalal Street. Namaste Arunji, and a very warm welcome to you, sir. How are you passing your time these days, given that there is practically no volumes on Dalal Street and everything seems to be in suspended animation after this Sebi order on Jane Street?
So, good afternoon to you, Shell, and to all your viewers as well. So, the last question first, how am I spending my time? The primary market seems to be super active. So, I've been doing a lot of traveling, meeting companies, and the level of travel has increased from twice a week to 4 times a week. So,
My God.
I have no regrets about market being quiet, lull, and actually I'm appreciating it that I don't miss anything, because at the end of the day when I get a call and the dealer tells me, "Sir, aaj kuch nahi hua," so I said, "Okay, yet another day of aaj kuch nahi hua." So that's on a lighter note, but let's understand what's happened. The exchange is a SRO, and observation of manipulation on the derivative trade is something which the exchange should detect early. In this particular case, Jane Street was warned, but no action was taken beyond that. I believe somewhere at the exchange having large volumes and getting tempted between allowing the volumes to continue, even though there was a gray area of manipulation, was overlooked. I'm using my words carefully, but knowingly that I would get people calling me up to say, why did I say what I did? One other thing is that the sucker at the end of everything that happens is that same retail investor who's not fully equipped to deal with what happens in option trading, and the lure of trying to make quick money from thin air
Yes.
is something which makes a lot many people lose their shirt. Even today, there were news items in the press which said that 9 out of 10 people are losing money on derivatives. The amount of losses is rising. But I believe post COVID, the number of people who are prepared to take these undue risks seems to be rising faster than one would expect people to be cautious. Having having said that, Let's understand what happened. There is a very funny thing that goes on in the exchange as far as derivatives is concerned. There is a concept of expiry day weighted average last 30 minutes, which means if you take a typical keyboard on a computer or a laptop, you have a F1 and an F2, which in stock market parlance is akin where F1 is buy order, F2 is a sell order. If you were to put a tape on F2 and you do not execute any sell orders in this last half an hour, and you have adequate amount of margins, you can move the price up to your advantage in a significant manner by punching in order after order on the buy side. This is manually. If you have system driven algorithms to support you, you can do this at maybe a speed of 100 times faster, where you're throwing in orders at speed of lightning, if I could use that term, and you are moving the price up to your advantage. Come 3:30, guillotine time, weighted average, and all the trades that you did in the last half an hour on the buy side, assuming you wanted to take the price up, gives you money for doing nothing other than pumping in orders and executing them. This kind of manipulation has been done multiple times over the last few months. Jane Street was warned, but no action taken. It needed Sebi to step in and ask them to disgorge some of the profits that they have done. We also need to understand that Jane Street is a SEC regulated entity, with SEBI having taken action against them. Retaliatory measures would follow sooner
Yes.
than later, even from SEC.
Okay.
So it's a very, very bold move that Jane Street did to make money in India.
Okay. Arunji, for the benefit of our viewers, there is if you could explain what exactly has SEBI highlighted in the wrongdoing by Jane Street. My understanding of the case is that this is under FUTP regulations, which is unfair trade practices, but a wide cross section of people are saying what is the harm in buying or selling options and simultaneously buying or selling the underlying. All of it is done in white, taxes are paid on it, and except for the fact that maybe the size of the trade was so large that Jane Street became a market in itself, they seem to suggest that there was nothing wrong in this whole setup. What is your view?
So, what is wrong or what is not proper is simple. As long as you do something which balances your trade out, there is no problem. But when you do it because you want the market to move in a particular direction, because of the quantum of trades that are done with you, you are milking the system. You are trying to make money where it was not there. You're catching people on the wrong foot. And the last half an hour, when this is done, is just not the correct time when you are putting so much of money behind those trades in that limited number of stock or the index, as the case may be. It also amounts to you destabilizing the market positively or negatively to suit your personal interest. So there is a certain amount of concentration of position which has been done. It has been done unethically for sure. Therefore, the fine or the hauling up by SEBI. Ethically,
Okay.
if you talk broader terms, if you talk, I come to the stock market to make money and I can make money. That is my objective, that is my goal. So, what is wrong in it? But the manner in which it is done is not the correct way. Therefore, this fining.
Fair point. Now let us examine what this means for the Indian options market, given the fact that over the last 5 years it has become increasingly automated and a playground only for the ultra HNI, the deeply pocketed people who can get into algorithmic trade, and of course you need huge amount of margin money to make the trade go in your favor. Do you think that the golden age of Indian options market is now over?
It's a tough question, difficult to answer right away. We can't take Jane Street as one example and write off the derivative market. But in the short term, there will be a setback to volumes. There would be people who would look at what happened, what went wrong, and what irked Sebi so much that they have taken strict action. We also need to understand that Jane Street, like mentioned earlier, is regulated in the US. So there is one regulator in India, one in US, who will also now start looking at this particular incident. And if there is cause for worry, for sure there would be people breathing down Jane Street's neck even in the US. The good part, however, is it's another wake-up call for retail investors that don't try to do things which do not suit your cup of tea, which are not as risk-taking, or your ability to risk-take, it is way beyond that measure. I think people need to introspect there also. The fact that you have a flat rate brokerage on a derivative trade or an option trade is no reason to take a higher risk. You can lose much more than what
Yes.
your capacity to lose is. And the worst thing possible is derivative is by and large a leverage trade. You are taking a risk far beyond what appears to be there on paper. So I
Yeah.
think all this will become a good wake-up call for those people who think options is nothing more than buying a lottery and being successful once in a while.
Arunji, that brings us to the third angle of the triangle, which is valuations of these capital market companies that were listed in on Dalal Street. I'll request the PCR to kindly show us the long-term charts of Bombay Stock Exchange, MCX, followed by Nuvama, and then Angel One and other brokerages. A sharp drop in volume is expected on options trades, as also cash counters are suffering. Do you think this space where valuations were bordering on the absurd will see a further fall in prices?
A very interesting thought, Shell. Let me give you a longish answer to a ticklish question. Recently, we had the listing of HDB Financial Services, the HDFC Bank. And if I take you back to 2020 COVID time, this share in the unlisted market, which is the third market that we have the quoted listed stock exchanges, we have a gray market which typically gets active just when an IPO is going public, and this unlisted market where shares issued as ESOPs, as various rounds of pre-IPO fundings are traded as long as the company does not go public. So these HDB shares were trading around March 20 at 1200, and that remained the price over the last 5 years. The share was issued at 740. It's trading closer to 825, 850 now. And people wondered what was the right price for HDB. Whether the merchant bankers did harakiri by pricing it as such. I remember when I was asked by media to make a quote, I said a price for a listed entity or a company going public can only be on its fundamentals.
Correct.
And an unlisted market price can never be the base for
Yeah.
pricing an IPO. And the size of this IPO was upward of 12,000 crores. So 740, which was the top end of the price band, was a fundamental price, and 1200 was a price which had more froth, more expectation uh, being built in rather than fundamental of fair value. That was one example of what happened. You are now talking of a listed entity, BSC, MCX, which are exchanges, and the soon, hopefully, to get listed NSC. NSE, there used to be a time when NSE shares were available only to investors who were approved by the exchange as being fit and proper. Subsequently, this term was eliminated, and we now see small people. By small people, I'm talking in their holding, less than 100 shares holding shares of NSE as well. This is creating a lot of expectation, and what is driving this price is twofold. First, the price of BSE. People look at the market share of BSE, the profitability, and then at the market share of NSE and its profit, and then come to conjure up a price which they feel is fair for NSE. This is driving expectations sky high and could be another HDB in the making as and when this issue happens. Let's come to the second point. People are also talking whether a share from a stock exchange should be listed or not. The fact that we already have two active listed shares and there is a third company where the exchange is not active, to now say they should not be listed, a lot of water has flown under the bridge. No point talking about it. However, the role of a SRO, like an exchange, which is a infrastructure company for stock market trading, is not necessarily to make profits, but to provide a platform for investors to interact and make money. And in the process of making money, quite a few lose money. So I believe we have a lot of things happening in the marketplace currently where another HTB is right to happen sooner than later.
Arunji, please put on your thinking cap, which is full of wisdom for the past 35 years. Do you think there is a government-led regulatory intervention coming into capital markets as far as options and derivatives are concerned via Sebi, which means anybody with a net worth of less than 5 lakh rupees or maybe 15 lakh rupees is not welcome? End of story.
So let's not get into number crunching as to what is the cutoff point, what is the point where the regulator or the government believes we should cut off entry and exit. But yes, over the last 1.5 years, this noise that is being talked about, that retail investors, small investors who do not have the wherewithal to weather shocks, who do not understand derivative trading, who do it for making small change money, but end up making huge losses because of the volatility, should not be allowed access to this segment of the market, which in any case is very, very risky. I believe it's time for regulation to come in from the highest quarters. It may be that it is formulated through Sebi without the government interfering directly, but the finance ministry, which controls the stock exchanges, and Sebi could give guidelines to the department to formulate such a policy with wider participation and do it. The sooner it is done, I believe it will bring stability to the markets and prevent bloodbath of innocent small investors. innocent as long as they get caught in sharp, volatile movements, but not innocent because they are taking risk beyond their capacity.
There was a very interesting quote that I came across where it was said that Sebi is saving the retail investor from himself. 90% of
So,
them lose money
yes,
and
you're
they refuse to
absolutely right.
understand.
You're absolutely right. This is a fact. And, just adding on to what you said, some time ago when we used to be asked what is the role of Sebi, they said Sebi regulates the small investor. And if the small investor becomes big by learning the fine art of derivative trading, you will have no small investors left in the system. So that is what people used to also talk. But I believe we have enough of people who are getting entrapped in derivative trading, option trading, which looks very lucrative, which allows very easy entry points, but is actually a thorn of a crown of thorns, if I could say so. And it's like the rose. It's very nice to hold, but you do get hurt with all the thorns around it.
Arunji, 45,000 crores made by a single entity in 18 months. Is this not lucrative? मेरे को तो
No, so
लगता है
that's what I'm saying.
ये अमाउंट देख देख कर और लोग आएंगे ऑप्शन मार्केट में.
Absolutely. So, current position is that Jane Street has been stopped. People are getting aware and they are also understanding one thing for sure, that stock market is a zero sum game. If somebody loses, somebody earns. If somebody earns, somebody loses. So if Jane Street has made 45,000 crores, a large number of people cumulatively put together have lost 45,000 crores, not taking into consideration the amount spent by people in brokerages on both sides. That would be separate. So when this kind of money has been made and also lost, it's certainly something dangerous if you're on the wrong side of the table.
Given the public uproar that's happening on Jane Street, do you think uh, what do you think will SAT do, where I'm sure this case is headed?
So I believe, as far as Jane Street is concerned, they have no option. Their source of livelihood in this country has been currently stopped. So they will have to go to appeal sooner than later. And probably you can expect that to happen in the month of July itself. Because it's something that concerns uh, a large institution making money apparently at the cost of hundreds of thousands of small investors. It would get fast track hearing and there would be some outcome sooner than later. It's also a test case of whether Sebi has done due diligence before passing an interim order. So it will be very keenly watched. But I believe till judgment comes out from SAT on this order, you will find, at least for the time being, people getting a little cautious on derivatives and not taking undue risk. I hope this caution becomes larger and continues for more time than a couple of months.
Okay. As they say in Mumbai, picture abhi baki hai. So this is chapter 1 as far as the Jane Street saga is concerned. Now the issue heads for SAT. And Arunji, as you would know much better than me, there is one set of people in Mumbai who are rubbing their hands with glee, and they are lawyers. Both parties will now get immensely rich fighting this case in SAT. And of course, as you say, this is a test case, a benchmark case for not only SAT but for our regulatory structure as to how we are headed. Till about 2 years ago, India's options market was considered one of the best in terms of liquidity and depth, as also trading volumes. Sadly, that has now been put out in the open. It was subject to some kind of manipulation. Let us see how the next 2-3 months pan out, and as they say, picture abhi baki hai, and we will be covering this saga with Arunji in greater detail and great depth. Arunji, before I let you go, anything you've added in your own personal portfolio for the long term?
So one company which I have liked from the recently listed IPOs was Oswal Pumps.
Yes.
It was a very interesting offering. If you see, government has a very innovative scheme known as Kusum, under which solar pumps and solar infrastructure used for agriculture is given subsidy by the government at both from the center and the state. It implies that you install a pump which uses power not generated by the grid but by a solar mechanism, which means even if there is no power, even if you are not grid connected, you can lift water from the ground or maybe a canal which is flowing nearby and irrigate your field. The kind of subsidies given vary from state to state, but it makes the entire scheme very affordable.
Okay.
Oswal Pumps is a company which is involved in making not only the pump, the solar panel, the control, the switchover from the pump to generating electricity for lifting the water, etc. And it does so in a very effortless manner. The one thing that I liked when I visited their facility was the extent of backward integration, where they make the winding wire used in motors, they make the packing containers in which this equipment is sent in corrugated boxes. They also do stuff like making extruding the aluminium, which is used for making panels and so on and so forth, trying to save every bit of cost and making the product that much more efficient. So I think this is a long-term story, and I don't think Kusum as a scheme is going to go anywhere in the immediate short term. There can only be improvements to this scheme going forward.
Okay. Ladies and gentlemen, Arunji was talking about a recently listed company, Oswal Pumps. Sadly, we can't show you the stock price. It got listed on June 20th. The issue price was 614 rupees a share, and today it's trading at 730. It listed at a fairly okayish price, hit a low of 613 on 23rd of June, and from that day onwards, it's been a single one-way movement. Market capitalization is 8,200 crores. Revenue for the past 12 months is 758 crores, and it's a profit-making company with trailing 12-month earnings of 97 crore rupees. Arunji, thank you so much for this lovely discussion and that final view on Oswal Pumps. May you remain in the pink of health.
Talking of pink, we both seem to be wearing different shades of pink, so it's very much appreciated, and I will rely on your blessings. Just one small point: the revenue that you have spoken about, Oswal, I believe is not the 12-month revenue. They have done closer to more than that, because they have declared their March results after going public. The figure is 4-digit. So if people will look that up, they will get a more comfortable figure to talk about.
Okay. With that, we'll call it a day. Arunji, thank you so much for this wonderful chat.
Thank you.
That, ladies and gentlemen, was Arun Kejriwal speaking at length on the Jane Street crisis that hits Dalal Street, both in terms of a very sharp fall in all stocks related to capital markets and, of course, the sentiment dent that it has caused on volumes. I hope you enjoyed the conversation. Coverage continues on Business Today Television. Stay glued.